Welcome to the Source of Commercial Real Estate, where we discuss all things non-residential commercial real estate, including finding and funding deals, market intel, finding a competitive advantage, and using real estate to live the life that you want. I am your host, Jonathan Hayek, and today I am talking with Joe Ricciuti. Joe is a managing partner at Ocean Block Capital, which he co-founded in 2017. Since then, Ocean Block has amassed $250 million portfolio that includes net lease retail, industrial, and medical office assets in 32 states. Joe has been involved in over $500 million of real estate transactions throughout his career and was recently recognized as a 2023 influencer in retail real estate by GlobeSt. Additionally, Joe has served as a panelist at several high-profile events, including the Interface Net Lease Conferences in New York City, as well as the Interface Net Lease West Conference in LA in 2023. In his spare time, Joe is on the Leadership Council at the Pink Agenda, a non-for-profit organization dedicated to raising money for breast cancer research and care. Joe, I am sincerely looking forward to this conversation. I love your website. I love your portfolio. This is going to be awesome. How are you doing today?
I'm doing excellent. Thank you so much for having me, Jonathan. This is going to be great. I'm looking forward to it.
Yeah, of course. Joe, why don't we start out with you telling us about your background, how you got started in real estate, and what your work in real estate looks like today?
Yeah, so again, my name is Joe Ricciuti. I was born and raised in Boston, in the South Shore of Boston, I should say, in Norwell, Massachusetts. About 11,000 people in the town. Everybody knows everybody, and grew up in a small neighborhood where, again, everybody knew everybody. Everybody was friends. And my next door neighbor, he gave me the opportunity to intern with him my sophomore summer going into my junior year of college. And he did wealth management. He's a financial advisor at Merrill Lynch. I had a tremendous experience with him that summer. And I remember asking him, hey, Dave, if you were going to do something different with your career, what would you do and why? And he said I would explore commercial real estate. And so I didn't necessarily know anybody in commercial real estate. So that fall, I went into my lacrosse coach's office at Hamilton College. And I said, hey, Coach Barnard, could you make some introductions to alumni in the commercial real estate industry? And so to make a long story somewhat short, he made an introduction to an alumni that, I should say alumnus. That alumnus is Zach Weiss, and he's now one of my business partners. Had an internship at Marcus and Millichap in New York City, working with Dan Corcoran, Preet Saberwal, and Zach Weiss at NNN, doing net lease, retail, and medical office sales. Came back after I graduated and worked with them on their team, and the rest is history. We founded Ocean Block, the four of us, in 2017, and we've been in business now for 6 years. So we have a 5,300 square foot office space that's just north of Grand Central. We have a team of nearly 20, and we have a $250 million portfolio of real estate that's comprised of net lease, retail, industrial, and medical office assets.
Okay. A couple things I want to hit on. I saw this pattern. So you're interning with your neighbor doing wealth management. He says, if you want to get involved in something, think about commercial real estate. Then you're at Marcus and Millichap, you're a broker, and you leave the brokerage side to start Ocean Block Capital to go on the investment side. So there's like a trickle of like getting closer to where you want to end up, and then finally, probably now you are where you're going to end up. So can you talk to me about the transitions from wealth management to commercial brokerage to now being on the investment side?
Yes. So initially, just to get my foot in the door, I knew that wealth management would be something that seemed interesting to me, because you were using both quantitative and qualitative skills. I've always been a numbers guy, but having relationships in business and personally is very important to me. So I knew that I wanted to be using both quantitative and qualitative skills. And wealth management was great, but then was introduced to commercial real estate, and I really enjoyed the tangible aspect of real estate and the fact that the actual asset and the investment you could touch and feel. So that's why I was so enthusiastic about real estate, and that's how I got into the brokerage world. And then in the brokerage world, that's where I really learned the ins and outs of owning real estate. And that's when I ultimately transitioned to becoming a principal in July of 2017.
So can you tell me about the types of deals that Ocean Block is doing right now and what's in your portfolio?
Yeah, so I can tell you this morning we actually just closed on a quick service restaurant in Fort Myers, Florida.
Congrats.
Yeah, thank you. It's right down the fairway for what we work on. I'd say that at this point, 40% of our portfolio is retail, 30% is industrial, and 30% is medical office. And again, we own assets in 32 states, but one day we might be working on a deal in Florida. The next day we're working on a deal in Washington. And the next day we're working on a deal in Massachusetts. And in terms of the deals that we're working on, they're predominantly value add opportunities where there might be an existing tenant that's in place and maybe the tenant's considering leaving, and there's an opportunity for us to backfill the space and bring in a tenant with a better credit profile or at a better rental rate than the existing tenant is paying. Or we'll go in and purchase second gen spaces that are vacant and we'll backfill with tenants that we have relationships with. So those are the two deal types that we're most enthusiastic about today, meaning July 19th of 2023. And that's what we're working on the most.
Okay. I love this. And I want to dive into exactly how you all are executing this. So are all of your properties single tenant?
No, I'd say 75% of them are single tenant, and then the remaining 25% are multi-tenant. And multi-tenant could be anywhere from 2 up to 6 tenants.
Okay. I'm going to read a piece from your website. I think this part of your website does a good job of capturing kind of how you guys operate. And then I want to dive into each part of the statement. So your website reads, "We are a well-capitalized buyer that never requires financing contingencies. Our dedicated attorney team and third-party vendors allow us to run seamless due diligence and closing processes. We are committed to being our word and executing at the highest level." Let's start out with the first part. We're a well-capitalized buyer that never requires financing contingencies. So tell me about how you are getting deals funded and financed.
Yes. So first and foremost, we've never taken outside equity. All of the equity is from myself and my 3 partners. And that has come from doing 1031 exchanges and recycling assets over time. So sell an asset, pick up 3, 4, or 5. And it's also come from adding value and then refinancing out and redeploying that equity into additional assets. But the statement that you just read with respect to we're cash buyers that never require financing, that's one of our Ocean Block value propositions. And what I mean by that is many brokers and sellers, they never want to be dealing with financing contingencies. That's always a red flag and considered a hurdle, especially in an environment today where we're in a rising rate environment where your standard rate is 6.5% to 7%. It's very tricky to get attractive financing. So what we have done over time, Jonathan, is we will purchase assets cash and then we will immediately refinance after the fact. So then the broker and the seller does not have to deal with a looming financing contingency, and it really speeds up the process. So that is our typical strategy. We'll buy an asset cash, and that's exactly what we did this morning with the Fort Myers site. We bought an asset for $1.5 million. We bought it cash. We already have a term sheet that's signed with a local credit union down in Florida, and we'll refinance that asset in 3 weeks. We'll take that equity that is trapped within the deal that we just put in the deal today, and we will redeploy it into the next deal that will close in a week or 2 weeks.
It's so genius. Talk about some of the advantages that you have, and some of the opportunities that buying with cash brings you. That I'm sure, I mean, a QSR in Fort Myers, Florida, there were probably other people interested. You guys got the deal. So tell me about some of the advantages when when you're submitting a contract with cash. What are some of the advantages that cash brings you?
Yeah, when there's cash, there's an assurity of closing associated with it. And when you have a track record of closing, right, because we're Ocean Block, we've closed hundreds of deals at this point, our letter of intent goes to the top of the pile. And mainly that's because, again, assurity of close, you know that we're going to close and we're going to close quickly. That's number two. And number three, we have a track record of closing. So I've seen recently more sellers in the marketplace are a little bit more inclined to take a lower price from us. Nothing crazy, maybe a 5 or 10% lower price because they know that we're going to perform because there's no financing contingencies in place.
And are you all still doing full due diligence on these properties? Are you doing selective? Like, I'm thinking environmental, things you can't see, sewer. What's due diligence look like on these transactions?
Yeah, complete due diligence. So we've expedited the due diligence process to be about 21 days, which is pretty quick. And I should actually note that the deal that we closed this morning in Fort Myers, contract to close in 28 days. And so that one we actually worked with brokers, Patrick Nutt and Will Womble, and they're at SRS down in Florida, and they're a treat to work with. But the day that the purchase and sale agreement was signed, we had the phase one environmental ordered, the survey ordered, the zoning report ordered, the title report ordered. We have everything ordered within 60 minutes of signing that purchase and sale agreement. And we'll even go as far to pay to expedite those third parties as a means to move as quickly as possible so that we can get to the closing as quickly as possible.
Okay, so this brings us to the second part of the statement on your website, talking about your team. Our dedicated attorney team and third-party vendors allows us to run seamless due diligence and closing processes. So, listening to kind of the system and automation that that you just explained, queuing up due diligence on day one that you're under contract. Talk to me about what your team looks like and how they're interacting, what's happening, what goes into motion when you get a project under contract.
Yeah, so I think we'll start with even the letter of intent, and this is another value proposition. This is the Ocean Block white glove service that we're going to provide to you, and that's everything from managing the process, working with our attorneys hand in hand, and our third parties. So when we sign off on a letter of intent, Jonathan, we immediately take that letter of intent once it's fully executed and we send it to our attorney team. Our attorney team will turn around a draft purchase and sale agreement within 24 hours. So once that purchase and sale agreement is negotiated, it typically takes anywhere from 5 to 10 days. Then it's executed. Once it's executed, then Michael Kiriak, our asset and transaction manager, who his nickname in our office is David Blaine because he's pulling off magic left and right, and he's so incredible. I don't have enough good things to say about him. He will, as soon as we have that signed purchase and sale agreement, he's putting in orders with third-party vendors for phase one, property condition report, if warranted, survey, zoning report, scheduling site visits, ordering the title policies. It's a very streamlined process that he runs. And then once the due diligence is waived, then we move to the closing period. And part of the white glove Ocean Block service that we provide is we'll even have our attorney teams draft the closing documents for the sellers, because we acknowledge that some people that we buy assets from, they're not professional real estate owners like us, right? They might be doctors or school teachers or veterinarians, whatever it is. We will try and make everybody's life as easy as possible. And so we streamline the process for them. So that is our second value proposition, which is that we run a white glove process, as I just explained.
Yep. So you make things easy on everyone, and there's a ton of value in that. I've done, that's been in my previous investing and doing single family homes and stuff, buying for cash and just making things super easy, making things fast. The seller doesn't have to do anything. I'll take care of everything. And you can get deals that way. You can get repeat business that way. You can make people happy that way. So I want to go into the specifics of the deals that you're doing. So if you can, you just closed a deal this morning. So I'd love to ask you about that deal. So we heard it's a QSR in Fort Myers, Florida. Tell me if you can tell me the tenant and what's the business plan with this property.
Yeah, so we bought a Wendy's property in Fort Myers. We've done quite a few Wendy's deals, and there's an existing tenant being Wendy's, and if Wendy's wants to be there, that's great. We're happy to have them, and we own a number of Wendy's in the portfolio, so we love the tenant. We also are very comfortable with the guarantee that the franchisee is putting on the lease. And in the event that the tenant wants to leave, we feel as though we have the dual threat approach. It's a high growth market in Fort Myers. We think that the tenant is paying below market rent, and we feel as though we could very easily backfill it in the event that we had to, and we could likely increase the rent. So that is our thesis behind the opportunity, and we're really enthusiastic about the deal and the market.
Talk more about why you like to buy Wendy's.
Yeah, so we have done a number of Wendy's deals, and we've partnered with many franchisees to help renovate their restaurants. So Wendy's corporate, they are pressing their franchisees to renovate their restaurants. It costs anywhere from $350,000 to $700,000 to do so, and you cannot re-up your franchise agreement unless if you renovate your restaurant. And not every franchisee has $350,000 to $700,000 lying around per restaurant. There are many franchisees that operate anywhere from 17 to 350 restaurants. So that's a lot of money, right? So we will partner with them, and we will contribute to renovate the restaurant. They will in turn get a franchise agreement extension, and we will get the lease extended coterminous with the franchise agreement. So it's a win-win for everybody. And we've done so much work in the Wendy's system. And it's one of those things where it's a small, tight-knit group. So if you do right by one franchisee, they all talk and they all know each other. So word of mouth has been our best friend throughout the entire journey and process.
So I'm trying to get a better idea of your business plan. So let's say there's a hypothetical QSR that has, what's a typical remaining lease term on a deal that you'd buy?
In some instances, it's 6 months or a year, and in other instances, we'll buy a portfolio of locations directly from a franchisee that will have 20 years remaining on the portfolio. So it really depends. I'd say our average is probably between 5 and 8 years.
Okay. And you know that in 5 to 8 years' time, the franchise is going to require something happen. So either this restaurant gets renovated, and I can picture a Wendy's. You'll see, old school Wendy's around. It looks like it's from the 80s, and so my guess is, they've had a lease for a really long time. They haven't had to do anything, but those leases are probably going to be coming up at some point, and the franchise is saying, "Hey, we've got to modernize a little bit." And at that point, the franchisee has a choice to make. So the franchisee could shut down. Is that an option if they say, you know what, I don't have 350 to 700K, it's just not viable, and so they could just shut the doors? Is that an option for the franchisee?
Yeah, it is. Once the franchise agreement expires, the franchisee could close. We've been a part of relocations, right? In the 70s, 80s, and 90s, there was one trade corridor, and maybe maybe it was a Wendy's or a Burger King or a KFC that was by an enclosed mall, and that enclosed mall is very vacant now, and the trade corridor all of a sudden shifted. Well, Wendy's wants to be, like any Wendy's franchisee wants to be where the new trade corridor is in 2023. So yeah, they could close the doors, they could relocate, and yeah, I mean, I guess that's their two options. They could also do a new site in the market as well. So,
and Ocean Block doesn't exclusively buy expiring leases. There could be, I mean, buying a deal with 6 to 12 months left on the lease is different than buying a deal with 5 to 8 years left on the lease. And so that 5 to 8 years, is that more of a longer term strategy, or are you propositioning them to say, hey, we can update your property sooner in exchange for signing a longer term lease and increasing rent? What's the play with buying a property with a longer lease?
Yeah, so with a 5 or 8 year lease, the benefit is you purchase the property and you immediately get to cash flow, which is great. So there's no delay in cash flow. You get to collect rent, and then the entire renovation process, it's not exactly quick. It doesn't happen overnight. So it could take as long as 12 months, right? And so that is why we typically like to have some term. If you have a 6-month lease, it's a really quick fuse and you have to move very, very quickly, or you have to have a tenant in your back pocket and you're ready to redevelop immediately.
So tell me more about the strategy of buying a property with 5, 7, 8, 10 years left on the lease. It's going to be a pretty low cap rate. So returns are going to be fairly low. Am I wrong about that?
They're not. The return is going to be better than if you bought a 20-year lease.
Okay.
So yeah, the returns are better than a 20-year lease, and they are worse than, say, a 1 or 2 year lease. But with a 5-year lease, again, you have the benefit of cash flowing for the immediate future for the next 2 or 3 years. And it gives us some time to really strategize and explore the market in terms of what tenant we could backfill with. There are tenants that are expanding like wildfire right now, Raising Cane's and Slim Chickens and Starbucks and Dunkin' Donuts franchisees across the country. So we like to have flexibility and we like to bid out the entire process to all tenants.
Tell me about, I want to focus on value add opportunities. That's the kind of investor that I am, and I think most of my listeners are value add. Mm-hmm. And so when I hear 5 to 8 years, I'm like, oh man, a lot can happen in 5 to 8 years. When I think of, buying a property with 6 to 18 to 24 months on it, talk me through your strategy with that. So we talked about one avenue being, hey, the tenant can stay. We'll help, with the remodeling of the interior and exterior, and re-sign the tenant to a long-term lease. Okay, but there's some risk there that there's some information that you don't have. Maybe their sales are bad. Maybe the franchisee's getting ready to retire. Maybe for whatever reason, that tenant is not going to extend. So can you talk me through your thought process and like the actions that you take if it starts to become clear that you're going to have an empty space here?
Mm-hmm. So in every deal that we purchase, there's a tremendous amount of due diligence that is completed. And yeah, we're taking a look at the lease and amendments, but we're really taking a look at the market. So first and foremost, with every piece of real estate that we acquire, there's an emphasis on intrinsic fundamental real estate. How is the real estate situated within the market? What is the lot size? What are the vehicles per day? What are the 1, 3, and 5 mile demographics? What are the 1, 3, and 5 mile median household incomes? What is rent and what is the existing rent that the tenant is paying and how does it compare to the market? I'd say that the best situation possible, Jonathan, would be you have a 1 acre parcel that's sitting on effectively main and main on the best trade corridor in town, and the 1, 3, and 5 mile populations are maybe 20,000, 40,000, 80,000, and the median household incomes are $75,000 plus. So that would be an ideal situation. And I think the real kicker would be if you have a tenant that's paying half of market. So in the event that the tenant did want to leave in 5 years, we're totally fine with it. We're comfortable hanging on to the asset. And if they want to leave, then we'll pull somebody else in and we will 2x the rent. One of our business strategies is we'll go around the country and we will buy C, D, and F tenants, and we'll backfill them with A and B tenants. Just some examples: Ruby Tuesdays, Applebee's, Long John Silver's. Those are all tenants that I would say that most people that are listening would agree are probably considered C, D, and F tenants. And I think that we'd all consensus agree that McDonald's, Chick-fil-A, and Raising Cane's are A tenants. And so we will backfill with those A and B tenants that I just mentioned.
There's so much here. Okay. I just love value add because it's been so, I've been investing in real estate for almost 7 years, and it's been so good to me. You can go so much faster and build your net worth, build your portfolio so much more when you're doing value add versus versus buying stabilized assets. There's a place for stabilized stuff, but value add is like rocket fuel to your portfolio. Mm-hmm. So first, how do you determine if you guys are operating in 32 states, so you personally can't possibly know market rent for all of the markets in which you're operating. So when you're looking at a deal and you're trying to determine, is this 50% off, or is rent 50% low? How are you determining that? What resources are you utilizing to determine if rents are super low?
Mm-hmm. So every single asset that we go under contract on, we'll have conversations with 3 or 4 leasing brokers that are in the market, and they will give a very clear picture as to what market rent is for a given asset in the market. That's number one. And number two, we will scour the market for rent comparables. So we're provided those by leasing brokers, but we will also pull our own, and maybe it's from CoStar, or maybe we can see permits that are pulled in a given market and we understand, okay, Starbucks is entering this market. We have a relationship with them. What's their rent going to be in this market when they enter? So then I have a little bit more of an understanding, and we have a little bit more of an understanding where rents are headed in a given market. But we have a pretty clear idea. I'm not going to say to the penny, but we have a pretty good idea with respect to range what market rent will be when we're under contract.
So talk to the maybe early stage investor. They don't have a $250 million portfolio, and they're like, yeah, there is this Long John Silver's that it's dumpy, and I want to put a McDonald's there. So talk to an aspiring value add investor who wants to execute this strategy. What should they be thinking about if they see this dumpy QSR that they envision there's a better use for? What should that investor be thinking about before they pull the trigger on this C, D, or F tenant?
Yeah, so they need to know, number one, the market. They should probably go see the market and see, okay, who's here, who's not here. Many of the burger concepts, they all follow each other. So that's why you typically see a McDonald's on a trade corridor with a Burger King and a Wendy's. And if Wendy's isn't there, there's a high likelihood that they want to be there. So go into the market and really understanding who is on the trade corridor and running a void analysis is extremely helpful. But in addition to that, Jonathan, you want to understand the specifications for each tenant. So Starbucks, for example, those guys ideally are looking for a 1 acre parcel where they can stack up to 20 cars. You'd have a drive-through. Realistically, now you need a drive-through with them, or you'd do an end cap, but that would still have a drive-through as well. They're willing to go multi-tenant and end cap in a strip center. So you really want to understand the specifications of each tenant and what they're looking for, right? Wendy's, they're okay and comfortable with 3/4 of an acre. Dutch Bros can make it happen in 1/3 of an acre.
Right.
And their Dutch Bros is playing out in California and Arizona and on the West Coast. So I'll give you a quick case study and example. So I'm from Norwell, Massachusetts, and I knew that there was not a Starbucks or a Dunkin' Donuts on the main trade corridor, and the Santander Bank hit the market. And immediately I said, there's a very high likelihood that Starbucks and Dunkin' Donuts will want the site. It's a 1 acre parcel and it already has a drive-through. If Santander ever wants to leave, Starbucks or Dunkin' Donuts will take this space. And when we went under contract, immediately Starbucks said, we want the site. The Dunkin' Donuts franchisee in the market said, we want the site. And now we have the classic situation where Santander says, we want the site. We don't want to leave. So now it's the perfect dual threat approach situation. We're currently cash flowing. There's 6 or 7 years remaining on the Santander lease. They seem happy, but if they're not happy, then we'll backfill with Starbucks or Dunkin' Donuts, because there's really nowhere else for Starbucks or Dunkin' Donuts to go on the trade corridor. And how do we know that? It's because we know the trade corridor.
So tell me about how you create relationships with these large corporations. If you want to know, you buy this bank and you're like, wow, this is a great deal. It's a great location. I know I can do 5 other things if this bank ever decides to leave. How do you have the conversation with Starbucks or Dunkin' or whomever to find out if they want the site? How do those relationships begin?
Yeah, a lot of it starts with the deal first. So you have to have a deal to have an engaged conversation with whoever tenant. You can say Starbucks. So that's number one. But number two, going to ICSCs and meeting face to face, that's extremely powerful. I would say the most important part of any business, not even commercial real estate, is having personal relationships with everyone in the industry, whether it's a title company, an attorney, or a tenant. Having that personal relationship is very important. But in addition to that, it's picking up the phone and introducing yourself and outlining the deal that you have and why you think it would make sense, and being able to present with a thesis statement.
Okay, the deal comes first, and then if you've got a great deal. But the problem is, like, if you're the example I gave before of somebody buying a Long John Silver, and you're like, okay, yeah, I'm gonna get Taco Bell or McDonald's in this old Long John Silver. What you can't just call up Starbucks corporate and have a conversation, I imagine. So are there things that if someone's looking at maybe it's a dark QSR, or maybe it is one of those tenants that you talked about before, maybe there's a drive-through and it's in somebody's hometown, you're like, I think a better tenant would want this space, but I'm not sure. Are there maybe like 3 or 5 things that someone can look at, whether it's access or traffic counts or demographics, or to just immediately eliminate? You know what? I'm probably not the first person to consider that McDonald's going into this Long John Silver. Maybe there's a reason that it's still a Long John Silver. Sorry, Long John Silver, we don't mean to pick on you. But what sorts of things can people, when they're analyzing a deal, what should they be considering before they make that call to McDonald's or Starbucks?
Yeah, so right off the bat, and I'll use Raising Cane's for an example. Raising Cane's is looking for, number one, population. So if it is not going to hit their population hurdle on a 1, 3, and 5 mile radius, then they'll immediately write it off. Then if it hits the population hurdle, the next is, does it hit the income hurdle, right? Can these people afford to be coming to the restaurant, and will they be coming several times a week? And then you move down the chain next, or you move downstream. The next characteristic would be, what are the traffic counts? Okay, it's 10,000 vehicles per day. That's not going to work, right? This asset or this parcel is not seeing enough traffic. If it has 40,000 vehicles per day, that's a different story. Then the next checkbox heading downstream would be access. Do you have access from both sides of the road, or is there a median? Okay, you have access from both sides of the road. Great. Now we're going to move to the parcel size. Is it a half an acre parcel? Okay, that's not going to work for Raising Cane's. Is it a 1.25 acre parcel? Yeah, we can probably make that work. And then the next checkbox would be, will the municipality approve a drive-through? Okay, they will. Great. Okay, they won't. We're going to have a very hard time, because Raising Cane's is not going to enter a space unless if they can incorporate a drive-through. And I've experienced that in the tri-state area, and I've also experienced it out in California. It's tricky to get a drive-through. Many municipalities are not overly enthusiastic about having more car traffic than there needs to be.
That was gold right there. Thank you for sharing those metrics. I want to talk about finding deals. So first, are the majority of your deals, are they through, how are you finding the majority of your deals?
A majority of deals are definitely coming from brokers and broker relationships. And the big thing that I would emphasize is I can tell you this firsthand, because at one point in time I was a broker, and whenever a principal picked up the phone and was actually nice to me, I always brought more deals. So I encourage everyone on my team, and myself included, if somebody picks up the phone and calls me, I will always give them the time of day, and at least I'm cordial. If I'm busy, I'll say, give me a call back or shoot me an email with the opportunity, or perhaps even speak to one of my guys. But as a result, because we are a warm and friendlier group and we invest time with younger brokers, many of those younger brokers are maturing in the business, and they don't forget the Ocean Block crew, and we've been good to them. And so they bring opportunities. And as a result of the invested time that we've had on phone conversations and meetings at ICSC, et cetera, we will be brought great deals, and we are purchasing many deals as a result of relationships that we've been building for the past half decade plus.
And are these generally deals that are brought to you before they hit the market? Are these before they hit Crexi and LoopNet, or at what stage are you seeing deals typically?
I would say 60 to 70% of the deals that we'll buy, they typically come to us before they hit the market. Those are the best deals. And most people just say, hey, we have a deal. We know that you guys are going to execute. We're putting this in front of a few select groups. Are you interested, or are you not interested? And that's exactly how that Wendy's deal in Fort Myers played out that we closed this morning. We were sent the deal pre-market, and we submitted an offer. We went back and forth a few times. We executed a letter of intent, and then went under contract 7 days later and closed 28 days after signing the purchase and sale agreement. So that's typically how it goes.
Okay. And you're operating in 32 different states. What suggestions do you have for people to build relationships with brokers? You talked about ICSC. Are you sending out letters to people, to brokers? Are you sending out gift baskets? Are you making cold calls? How does it work building relationships with brokers with deals?
Yeah, I would say we're not sending gift baskets, but if we are making a site visit down in Wesley Chapel, Florida, we're going to see the site in Wesley Chapel, Florida. We're going to see the site in Fort Myers, Florida, and we're going to try and meet every broker that's active in that market that's done a deal over the past 24 to 36 months. And we're under contract at any given point in time on between 15 and 30 deals. So we're on a plane, train, or automobile just about every single week, meeting or going to see sites and also meeting with brokers. So again, having the personal relationship with brokers is very, very important. But in addition to that, at ICSC, specifically at ICSC in Las Vegas, it's having a drink with a broker that we've closed a deal with, or maybe we want to close a deal with a broker because we know that they've done 50 transactions over the past 18 months. So it's just getting in front of those guys, letting them know, hey, we're Ocean Block, we're active, we want to work with you. It's mission critical that we get a deal done together in 2023.
What's the best way to share your track record? Are you do you have like a digital portfolio? Are you just telling them verbally, or do you have enough of a reputation at this point that brokers just know you?
At this point, we have enough of a reputation where brokers know us, but I don't want to discredit the little drip marketing pieces that we incorporate every single month. I mean, we're posting once a month a featured acquisition of the month, just letting the brokerage community and the principal community know, hey, we just closed on an asset in Mansfield, Massachusetts. We're very active in the Northeast. And if you're interested in selling your 7-Eleven asset or your convenience store asset or any asset that's net lease that you own in the Northeast, give us a call and we'll turn around an offer in 24 hours if we're interested in purchasing the property.
Tell me more about what that marketing looks like. Are those email newsletters? Are they LinkedIn posts?
They're predominantly LinkedIn posts, but we incorporate LinkedIn, Instagram, Facebook, and YouTube. We don't do TikTok for Ocean Block because our consumer is not from the ages of 15 to 30. Our typical consumer is from the ages of, I'd call it 30 to 80.
So that's interesting. Most people on those platforms are targeting limited partners. You guys don't have limited partners. And so really your target seems to be brokers and sellers?
Correct. Yeah, because we're just purchasing assets for our portfolio.
Okay. I want to go into 1031s. I know 1031 exchanges have been a huge part of your strategy. It is completely mind-boggling to me that you've built a $250 million portfolio without taking outside capital. I seriously admire that. I think that's amazing. And so let's talk about 1031s. 1031s can be great, but they can be difficult to execute if you don't have steady deal flow. So can you walk me through any suggestions that you have for other investors in executing a 1031 to come out with a great outcome?
Yeah, my suggestion would be as soon as you go non-refundable on your down leg, you need to be scouring the market and finding your up leg properties, because the last thing you want to do is start your 45-day identification period with nothing in your gift basket or your shopping cart. And by the time day 35 hits and there's 10 days left, things can get very stressful. We have been in that situation where it's day 44 and we still need to allocate some equity, and it's a very stressful situation. And the last thing you want to do is blow an exchange or have any issue with your 1031 exchange. So my suggestion would be, as soon as that down leg goes non-refundable, you need to be scouring the market and you need to find your up legs ASAP.
Do you, I'm not going to try to use the up leg, down leg terms because I get them mixed up and I'm just going to confuse people. So tell me about kind of the sequence of events. Do you identify a potential purchase first, or do you identify and bring to market the property that you're selling first, or does it just depend?
95 times out of 100, not that I've done 100 1031 exchanges, so let's just say 95% of the time we will sell a property and then that we'll just do a standard 1031 exchange and then we will pick up legs. On one occasion, we did what's called a reverse 1031 exchange, where we actually purchased a portfolio of industrial properties in upstate New York, and then we sold the down legs thereafter. So we did not love doing that, because had the purchasers of the down legs known that we had already closed on our up leg, they would have had leverage in the situation, and it is not something that I would recommend or I would do again. This was maybe 5 years ago. So that's why we typically like to sell the down leg first, the equity sitting with our qualified intermediary, and then we deploy when the up legs are ready to close.
Joe, I've loved this conversation. I am definitely going to have you back, because we haven't even talked about industrial. We haven't talked about medical office space. Those are two asset classes that I am involved in and really interested in. I have a few more questions. They're designed to go a little quicker, but feel free to elaborate and spend as much time as you want. First, what is the best deal you've ever done?
The best deal that we have ever done at Ocean Block, in 2020, we purchased a Wendys property in North Carolina when the tenant went bankrupt. And so we purchased the asset, and then 6 months later, the franchisee was the bankrupt tenant was then transferred over to a new franchisee who started paying rent. And then 18 months after that, we received an unsolicited offer at 100 basis points more compressed than we had priced the asset. And that deal ended up being a home run. That was a really, really good deal. But at the time, it was definitely risky. No lender was willing to lend on a bankrupt tenant that wasn't paying rent. So that was just an example of us taking a business risk and it paying off.
And did you sell it dark, or was it just occupied by a non-paying tenant?
It was being occupied by a non-paying tenant, but then when the new Wendy's franchisee came into place, then they started paying rent and everything was completely fine. So when we sold it, it was stabilized and it was a cash flowing asset and everything was completely fine.
What's the worst deal you've done?
Worst deal that we have done as an organization, and I'd like to come out and say we've actually never lost money on a deal, which is great, but we've had one or two close calls. And about a year ago, we were working on an Arby's in California, and we were working to put a drive-through at the location. It did not have a drive-through at the time. And we were working with Thousand Oaks, and Thousand Oaks said, yeah, we can make it happen. They said again, yeah, we can make it happen. And ultimately they rejected it because they were very focused on pedestrian-friendly Thousand Oaks, and they didn't want more vehicle traffic than there needed to be. So we ended up selling the asset to an owner-operator who was using it for a medical office use. She was happy. We were happy. It was a win-win situation, and we cut bait on that deal. That deal was not a great one, but it's okay. We still made it on top, I should say.
You learned from it, it sounds like.
Most certainly.
Which is the idea. So former Arby's turned into a medical office.
Correct, yeah.
Okay. What is your top tip for finding value-add deals or distressed deals?
I'd say it ties back to what I was saying earlier. Have the conversations with brokers. Even if you're super busy, give some brokers the time of day, give them 2, 3, or 4 minutes of time. And if they bring you 5 or 10 opportunities, it doesn't take a month to underwrite a net lease opportunity. It can take a day. And so my recommendation would be to be nice to brokers, because you never know when they bring you the right opportunity, that value add opportunity that you and I are referring to, it could lead to a 7-figure return for yourself.
When you, in your early days, when you were starting out, would you have done a mediocre or borderline deal in order to establish a track record and build a reputation and do deals, even if it's not a great deal?
No,
Okay.
I would not have, and we would not have, because in the event that things went wrong, it could have completely wiped us out at first, again, because we're using our own equity. So we were only doing deals where we knew it made a tremendous amount of sense for us. And we were very selective, and we're still very selective, for the record. So we don't just do deals for sport and for fun. We do deals because they make economic sense for us, or we're just very long on the real estate.
I usually ask people about raising capital. I'm not going to ask you about raising capital, but I'll ask you about working with lenders. So what is your top tip for getting the best deal with lenders?
So we have relationships with national lenders, regional lenders, and local credit unions. And my best piece of advice would be to bid out the deal and try and get the best terms possible, whether you're looking for interest only, the best interest rate, a 30-year amortization schedule, max proceeds, 70, 75, 80% LTV. You have to put the deal in front of 6 or 7 groups and not just run with a group that you're comfortable with. And if you don't know anybody, then you should probably speak to a mortgage broker, because there are some very talented mortgage brokers scattered all across the country, and they have relationships with lenders. So that would be my recommendation.
Joe, what book, podcast, YouTube channel, or other resource has been helpful to you that you'd recommend other people check out?
I would recommend the book The Alchemist by Paulo Coelho. That book is so incredible, and I probably read it once a year, and it just makes me take a step back and really enjoy the journey. So many times I'm focused on the next deal, the next opportunity, the next marathon, whatever it is. But sometimes it's really important to sit back, reflect, and enjoy the journey that we're on here. So that would be my recommendation for a book. And for a podcast, I really enjoy Armchair Expert with Dax Shepard. He has some incredible guests on that range from Matt Damon and Matt McConaughey to just about any athlete or actor or actress you could think of. I just listened to one with Chris Paul, and it was incredible. So that would be my podcast recommendation.
Joe, I didn't get through like even a fraction of the questions that I had for you, but our time is up. This has been a fantastic conversation. I admire the work that you and Ocean Block Capital are doing. I love the idea of using all your own equity. If listeners want to connect with you, where would you like to send people?
Yeah, have them reach out to me over LinkedIn or over email. And my LinkedIn is, you just look me up, Joe Ricciuti, and my email is jr@oceanblockcapital.com.
Perfect. This has been a great conversation, Joe. I sincerely appreciate you taking the time out today, sharing your wisdom and experience and expertise. Thank you so much for being here, listeners. Thank you so much for listening. If you'd like to connect with either one of us to talk about commercial real estate, we would love to speak with you, so feel free to reach out to us. Until next time, take care.